2023 has been the year where buying the dip has worked the best. However, is that about to change? Hello, ladies and gentlemen, and welcome back to the Daily Show where we talk about stocks, commodities, and cryptos. Today, we'll be looking at a deep dive into 70 years plus of data history that shows us what generally happens when we get such strong reactions after a negative day. Markets seem to be rebalancing into this idea that no recession is coming. But we've got some data that shows that there is most likely a recession coming, and it might be a little bit worse than some people are expecting. So sit back and let's get into it right now. Well, welcome back everyone to the Daily Show. If it's your first time here, consider subscribing and of course smash that like button. We'll be covering the macro, the latest news, and of course the key levels with the hottest charts with all of those zones coming up. So let's talk about recession because, of course, this has been something that people have forgotten about since markets have gone back up. It's all been about interest rates and it's all going to be about inflation, all of these types of things. But remember, the Federal Reserve is basically engineering a recession. They're engineering a deeper, darker period. And with the likes of what just happened in the oil market this week, if you're not aware of that, oil spiked pretty heavily due to a cut in production. We could be seeing a faster and deeper recession than we used to think about only a few months ago. In fact, PIMCO has said they've seen a risk of sooner and deeper recessions. And we'll be showing you throughout today's video why that is most likely the course of action throughout 2023 into 24 and how everything's changed, especially over the last couple of weeks. So what about smart money inflow versus dumb money? This is a chart we often use to see whether we've reached highs. When dumb money, which is this chart line here, overtakes smart money, we have to start getting concerned about the key levels we are at the market. And you'll notice over the last 24 hours, we hit that magical 4140 zone, which we've been talking about in the S&P 500 for many, many days now. Now, this is a critical level and we saw a reaction to it. So we'll talk about that hot chart later on because it's very, very important. But this switch here is the one I want to focus on. Smart money has begun dumping positions and they're most likely dumping it into retail buy the dip purchases. So it's a critical time for markets and a very important zone. So let's understand this mentality of buying the dip in 2023. Basically, every single day we've got a down day. The following day through Q1 so far has been followed by a pretty positive day, 0.32% on average. But on average, it's been followed by a buying session. Now, you go back through all of this history, even more than 70 plus years, it's pretty rare to see markets that have actually found 0.32 or 0.3% plus kind of rebalancing upwards. And in fact, when we've got these readings in the past, there is generally a positive correlation with the next 12 months. This is through to Q1. So you can see some of the times here. Now, there are some notable ones. It has happened a few periods of time back here in the 1920s, back over here in 2007, where you could pull the data out here and say it happened just before a watershed moment in stocks. Now, if that's true again, it's going to be a bit brutal. But it happened back in 15, 16. We also saw it in 2007 and, of course, the other periods. And you'll notice it leads into usually a bit of a shaky period over the next 2 to 3 months. So I think we're in a pivotal point here where the next 3 to 6 months in particular will make or break this market for bears in particular and whether we're going to get out with a soft landing. If we look at some of the best reactions since of Q1 through 1950 to now, you can see some of the best periods. Again, that changes the stats a little bit. But I also want to talk about if we'd seen the negative data. Now, if we'd seen the negative data where next day returns after a sell-off day had been in general negative, you can see it really leads into a mixed year. So there's no doubt that if the algorithms are working incredibly well right now, which is that they're convincing everybody that these markets have got breadth, they've got thrust, they've got so many things we've talked about on this channel for so many days now towards the bull side, they're triggering so many bullish signals. But that doesn't mean that we're not going to see a recession. Remember, at the moment, the bonds market is fully predicting it. We also have to bring ourselves back from the FOMO and say, well, are we even cheap on markets right now? Well, the S&P 500 forward PE ratio is certainly not cheap. 18.6, probably about 18.8 at the time of this recording. And it's well higher than 17.3, which is the average. And 16.8, somewhere in that range, which is usually where you want to be buying those investments. If you're a trade investor, if you're an investor, you need to think about forward PEs. Markets trade in the future. We all know that. However, if it's underneath by a standard deviation, well, that's a time to be pretty smiley faced about the markets. We also know that the problem with forward PE right now has to be to do with what all these economists are thinking earnings estimates are going to be in the future. They're looking at the markets of having strong recovery. Now, if you're a bull believer, then of course you're going to go, yep, they're completely correct. But they're certainly not pricing in much equity risk. They're not pricing in maybe the Fed pivot and the way that those work. We'll look at that very, very soon. And they're certainly not really thinking about recession. That's certainly not a word that comes into mind when you're looking at these types of earnings. So have they got it wrong? And if they have got it wrong, then they may need to adjust down. I asked you in your comments yesterday, and what I'll start doing is I'm going to pull out a few comments from the comment list down below. And if you've got a good comment that you want to say about the market, or you want to give some of your opinions out there, then put it down there and I'll actually focus on bringing them into the show. I thought it'd be great to bring the community into this show and see some different ideas and share those. If you like that idea, put it down in the comments. So let's talk about here sentiment, because we know that one of the reasons we led to this bullish move was too many people were bearish. This is going to be a big one this week. I'm looking forward to seeing the surveys coming out and how people's perceptions have changed. You'd be surprised how fast, like a click of a finger, things can change. So I wouldn't be surprised at all if this bearish level goes down underneath 40 this week. And I will update you. So make sure to subscribe for that, because that's going to be a big one. So we're going into a good period of time for markets. Historically, yes, technology sector usually struggles a bit at the start of April. That's where we are now. So we usually go sideways. To be determined if that's true. April tends to be a bit of a rally, and then sometimes May goes down for that sector, and that's what's really riding these markets. We also know that S&P 500 has been mostly bullish in April's, 2022 obviously excluded, but this is one of those periods of time that a lot of people are going to play that game. But let's talk about where the markets totally disagree with each other, and this has to be to do with being able to read bonds to reading stocks. Now, stocks are saying buy the dip, buy the dip, buy the dip, buy the dip. Everything looks great. Breadth, thrust, everything's fantastic. I tend to like seeing the stocks and the bond market come together, and they just don't agree. They do not agree at all. In fact, we're seeing readings now that in the bottom 7% of all readings. And in the previous video last week, I told you that leads to a kangaroo style market or a sideways style market. Now, stock volatility has plunged. We've got a VIX underneath 20 at this point, whereas bonds are freaking out, credit default swaps and all these types of things are freaking out a lot. So here are the readings for the S&P 500 over that period, and it tends to lead into a lot of similar times, especially those negative times, where we've seen buy the dip mentalities come back into markets, but they were wrong, and then markets went a little bit worse. Now, I'm not saying it's GFC 2.0 here, but I'm definitely saying that we could be going into a tough time over the next couple of months. And the main reason is also because of this. Here's where we are at the current stage. We're following a no recession path. That's how the S&P 500 sees it, a soft landing path. But it becomes more and more likely each day with Credit Suisse, with the way the Fed's having to react, with the oil market, with everything else, and what the bonds are doing, that we're probably heading for some form of either mild to semi-mild, severe recession. So this becomes more likely. Therefore, it becomes more likely that the markets will start to get earnings compression. So let's talk about why we might see earnings compression and why the forward earnings estimates could be wrong here on the markets. And that's because we usually would have had lagging Fed hike impacts. Now we've got, since Credit Suisse, Silicon Valley Bank, etc., we've got the lagging Fed hike impacts, plus we now have tighter credit conditions on businesses that don't really make money. So they're going to find harder to get money in this current environment. So it's estimated that between 10 and 15% of the major indices around the world, especially the Western world, are made up or comprised of businesses that cannot actually pay back their own debt properly. So this is going to be a problem. And of course, at the moment, what's happened is the Fed's balance sheet has come back up. But do remember, lagging Fed hike impacts have been increased or exacerbated by these tighter credit conditions. And that's why most likely the Fed will only rate hike once or twice more max, and probably they'll just pivot and sit. And what they'll do is they'll hold it until inflation comes underneath, because remember, this is what we need. We need inflation coming underneath the federal funds rate, and then they will be able to cut. But the market expects cuts almost instantaneously now. They say pivot, cut. We need pivots and cuts almost instantly to support the earnings, to support the GDP. which is now expected to retract a bit here in the US. Couple this with what's going on with the OPEC issue, and you've suddenly got a reinflation occurring due to energy prices going up, and you've got a problem for the Fed. Do they rate hike to try to combat that? Do they hold? They certainly don't seem to be able to cut at this stage. So remember, the Fed never pivots. And I'll say this on this chart right now. The Fed never pivots out of the goodness of their heart. During each one of these red arrows down here, they do it because they broke something. And during all these hike periods, even the ones over here, you can notice that when they start cutting again, markets tend to go down over that period, but they have a sugar rush coming into the pivot. And that's what we've seen right now, a market going up into the pivot. So it's actually following the perfect track record of what's happened around Fed pivots. We go up, things look great, and then suddenly they don't look so great. So similar times to some of those buy to the dip situations that weren't so good. Of course, the stats all look great towards the bull side. And I always say be optimistic in markets, it is better, but we have to look at the evidence on hand. We can also see here that EPS growth turned negative recently. Well, I'm not sure if EPS growth and forward PEs are really agreeing with each other at the moment, but that is there. And we can see ERP tends to spike up, which is basically the risk on the markets in comparison to risk-free rates out there like treasuries or cash. So what this means is usually if we do get a recession, which of course the bonds market is calling, then we should see a compression on stocks over that period. So we do expect that markets are going to have a troublesome time, and that maybe this is one of the critical levels we need to be focused on. This and around 4,300, 4,350 for the SPY are key zones. Now, never forget that one of the most important factors of what's really driven us up here, especially over the last couple of weeks, has been technology stocks, and it's thanks to the Federal Reserve. Now, this is my own kind of indicator that I use to combat not just the assets kind of being purchased again, or at least some kind of market liquidity coming in from central banks around the world, but it's about everything. And I try to take it all into consideration to see all the markets across the board. Now, recently we saw that kind of go back to here. So we're basically sitting around this zone at this stage. If we consistently see this going down and the market's going down, it makes sense. If I see this switch, I'll be the first to let you know. And of course, subscribe for that because it will be very interesting. If we look at underneath the hood as well, we see markets went defensive again for another day. Utilities, healthcare, and staples made up some of the best sectors for the market for that session. Meanwhile, energy took a bit of a dive, industrials took a dive. All of these kind of sectors weren't holding up anywhere near as much. If we go to the next 5 days, you can see the big top off here on energy. As we thought, it was a bit high and doesn't really make sense. These OPEC cuts tend to just be a sugar rush that usually rushes off the market. So that's pretty much normal what we see there. And we can start to see things like staples stagnating or coming up a little bit. Utilities also holding their own the last couple of sessions. And a little bit of rotational switch as we approach these higher levels for the S&P 500. So we've got so much stuff going on. We've got buy the dip mentality everywhere. Then we also have, of course, a Federal Reserve that's expected to pivot. And we know that the market is coming in and saying, well, we think that yields are going to need to be way lower. So let's have a look at that story right now. We know that when the Federal Reserve funds rate goes above the 2-year rate, that's usually a bad sign. That usually means a pivot's coming. But if we go back to the previous pivots, they usually hold rates for a period of time. And that is what I expect them to do this time. This has got to do with credibility. And we could say that the credibility of the Fed is shot. A lot of you are probably yelling at your screen saying, Tom, they have no credibility. What are you talking about? But I think they've got to have some credibility here when it comes to combating inflation. They've never beaten inflation. And I'll say this is not my words. This is Stanley Druckenmiller's words. They've never beaten inflation without pushing inflation that is underneath the federal funds rate. So they need to push it underneath, and they usually need to hold it so that inflation returns back to their target of 2%. They don't need to get it all the way down there, but they certainly need to stabilize it. So it's unlikely they're going to want to cut. And I think this is the big disconnect between the markets. The US 10-year here we see is coming down to a key level of 3.32. Now, 3.32 is a big zone. You can see it's the previous lows. A closure underneath here is going to show very large sickness in the economy. But it also shows us at pretty much a key level where I expect us to be hovering somewhere around here generally into the jobs numbers. But take a look at all of these other reads. Let's look at the US 2-year. US 2 years back to where it was during that Silicon Valley Bank crisis. We're basically back at the lows. But I think where the big change is here is interest rates moving forward. So let's have a look at September. September is now pricing in at least a cut. I don't know if the Fed's going to do a cut before then. December is pricing in 4.23%. It was at 5.5%. So they're expecting that the funds rate is going to get cut multiple times. Can the Fed actually afford to do this? Let me know in the comments down below. Maybe I'll put a poll out and we'll get the poll result. Watch the next video and we'll find out what everybody thinks, because I would suspect that the Federal Reserve is not able to cut as much as the market expects them to be able to cut. And I think this is where the big disconnect lies. Let's have a look at the last 24 hours. Did we see markets going down with high yield? Yes, we did. High yield went down, market went down. These are junk bonds, so usually you want to see them going with the market. It makes more sense. And in this case, they went down, which is good. Treasuries found some strength thanks to the lowering of the US 10-year and 20-year yields. So basically, we saw Treasuries finding strength. And this is not exactly, I still would expect Treasuries to usually be at 109.58 at this stage. So they should be around there at a 3.32 US 10-year. So they're still a little bit maybe undervalued due to the heavy selling that's probably come through from China and other markets as they deleverage themselves into Treasuries. So certainly it's a little bit lower than you'd expect it to be. Now we move on to the lead indicators. Dr. Copper had a shocker, and it had a really bad day. So we've been sitting here looking at this thing every single day. It finally broke low, which tells me that copper's starting to sniff out some weakness in the economies around the world. And this also shows you usually demand destruction is in play. So if copper continues to weaken, then and the market, let's say, goes up, that's not a healthy time for markets. So you'll see things like the ASX 200 and FTSE and other older economies, parts of the S&P really perform poorly during this time. So this is a bad move for copper, and it kind of marks the first bad day here for a while that could come through with non-farm payrolls to get us towards that 3.7 level. And this is not going to be positive for markets if we continue to see this. So watch copper on your charts. It's an important chart to have there. And they see this as the stability of the worldwide economy. Now we move over to the dollar. I mean, what a shocking close for it. You can see here the weekly, it's gone through everything. Dollar looks like it's getting absolutely rampaged. We've liked this level down here a few times. We found buyers initially, just nothing there in the last 24 hours. So if we have a look here at the 2 hour, we just couldn't find a bid. I mean, we had the bid here originally, and then we came back down, and you would have thought there would be some bidding in here. Then there was nothing. There was absolutely nothing holding the dollar up. I mean, I would say this is a huge, it's multiple things. It's the US yields going down, which obviously makes it less desired for the dollar. But I also think it's kind of like this BRICS versus SWIFT system. A lot of things attacking the dollar at the moment, but this is a pretty bad daily close for it. And you'd have to think rallies are going to be met mostly by sell demand at this stage. We're coming down to the critical 101.025, which might be a zone for scalpers to watch over the next 24 hours. But yeah, dollar looks really bad at this stage. And we knew that up here it was going to find weakness. This was very expected. Obviously, we had that watch reaction. But down here, I thought there might be a bit more buying, maybe push us back here, and then we go low. It just doesn't seem to be that way. It's like a fully fledged attack on the dollar at this stage. So let's move over to gold, and it was a pretty nice breakout here. I suspected it may pull back a little bit more before it went for this rally, but yeah, it was all to do with yield, you would have to think, and also that massive attack on the dollar that we saw over the last 24 hours. If we move over to 2020, I'd say around 2030 has been a tough point for gold to move through easily. In fact, it marks a very large closure zone. And what I'm looking for specifically on gold this week is weekly closures. I am quite bullish on gold, but if it manages to hold up through the non-farm payrolls this Friday, the jobs reports, I think that's a huge deal. We would move through 2 long leg dojis, which would basically show us this was an accumulation range. And then from dips from that point, you would have to think of being bought at this stage. So it gives us a really nice break closure, which can confirm some key levels. Along with the dollar, these are 2 massive closures coming into this Friday. Natural gas, the Widowmaker comes through the low, still finding buyers at these levels, which is good. We're looking for a nice breakout. I'd like to see something like natural gas break above $2.26. And if that occurs, we probably did see the low there for the short term, and that should hopefully begin more rallies. I do like natural gas at these levels. However, it's always a risky trade, so you've got to be prepared for that. What about oil? Oil has maintained itself at this supply zone. We know everything through this area here of 82 to 80 is critical, and we could expect maybe switches like this where it takes the high, but you just don't really want to go into that trade, I feel like, at the moment. The better one has been to attack the energy stocks instead, and oil per barrel is just trading right at resistance. We need more information. Let's move over to Tesla. Now, Tesla it found an early rally, but didn't really hold up that well. Ended up falling 1.12%, and we're trading at about 192. This is a pretty big gap that's been left behind by Tesla, which might be helpful in the future. But this was a fairly interestingly traded zone. I do like Tesla, but I mean, overall I have been negative on it. I've obviously been talking a lot about 150, 145 and going and cleaning up some of the gaps that are down here. So at this stage, we have to really go, okay, where are our big buying levels? Well, we would expect buyers to try to show commitment kind of around where they are now, but also around that 185. If markets can't recover and we get underneath 185, I think that's going to be a big problem for Tesla. So something to look out for, and we'll be watching that along with the options moving forward through the rest of this week. Nvidia, Apple, all of these stocks, they had sell-offs. If you look at Apple here, it sold a little bit, not considerable, so we'll need to use the indices. I don't think there's too much edge on either of those. A notable one that was really nice that we've focused a few times in the private community and talked about was Johnson & Johnson. Beautiful breakout here. Excellent aftermarket hour news. I believe they resolved something and spent up billions of dollars on some recovery lawsuit. But yeah, just absolutely a stellar trade that came through recently. And it just shows you there's opportunity in markets that is a little bit different to maybe what you're looking at. Yeah, okay, J&J is not a great stock most of the time, but sometimes, like Intel recently, it's been good. And those types of ones are the ones you're looking for in these markets. Follow replication strategies whenever possible. Now let's have a look at what else is going on. Energy hit one of our critical levels. We talked about this, probably wanting to fill the gap, and it did find weakness. I'm not won over by this energy rally. I think we're in demand destruction. Copper's showing that. The Federal Reserve's rate is showing that. Yields are showing that. Yeah, this is more of a sugar bust, and I know everyone's upgrading their energy calls, but I'm going to go against that and say I don't really have that much faith in it for the time being. And I just don't have faith in it. I don't see how this is not demand destruction across the world, and we could see markets go down. Another one that I've talked a lot about recently has been utilities. It held well, and it's getting ready potentially for a new bust high. It is a defensive sector, so I'm going to set alerts above this. It doesn't mean you go buy it, but it does show you those types of levels are zones where if markets are going down and people are rotating into things like staples, utilities, it's worthwhile paying attention to that. And it's another one that I've focused on now for a little while, and it's done okay. Let's go over to RSP. So this is an equal weighted S&P. It gets rid of kind of the noise that we get from the technology sector, and we can see the beautiful trend line that we came off. It was one of the reasons we believed that we were at critical levels over the last 24 hours, and also one of the signs that we thought, okay, bears should commit here. They did for a session. Let's look at the key levels across all of the markets right now. DAX, where it is, absolute critical. You can see those highs, and you can see here with the DAX, you go smaller time frames. You're looking for the DAX underneath things like 15,550. And the reason why is because that would then mean that this could be a false break. So if that's a false break and we have a high, low, higher, high, lower, low, it kind of points into, okay, well, now we may have just seen the top for now for these markets. XJO, Australian market, for the Australian viewers out there, it's also at some critical levels. We're kind of pulling a little bit further back than you'd expect through this support becomes resistance. That's not unusual. And I think the markets could even go up to 7,300, but anywhere in here is where I'm looking for those bears to recommit. Copper falling is not going to be great for this market. So stay tuned. Non-farm payrolls, jobs numbers this Friday. Everything will revolve around that. The Russell 2000, it failed, and it actually closed underneath the doji here. This is the futures market. Look at this, big red candle, long leg doji closure. Rallies should be met by sell demand. At least that's the way it looks at this point. And it happened at absolute critical for the Russell. We spoke about this being the lead sometimes for other markets. It just doesn't look good. It got sold off massively, very, very aggressively. We also know that our Q's hit into our red box. So very, very happy with that level, obviously. This is something we planned on. So very, very proud of you guys. Did well to figure out that zone, to make sure that we're at critical levels, that we're always focused on these big, big areas. And we did see some weakness. Now, the NASDAQ didn't find that the exact weakness. Look at this daily close, long leg doji. So we can go down to a 2-hour and you can actually start to say, well, wait a second, where are the buyers? So this still could be where we go boom and go through. I suspect it's not, but could be. Anything could happen. So you got to be open to both sides. At this stage, we're looking for this 13,000 kind of 30 zone to be closed below on a significant time frame. I'd like to see this market go underneath this level, and then if rallies happen, we have to expect them to be sold. So yeah, that's going to be a very, very important thing to look at. If we go over to the SPY, nice little engulf here happening at one of our key zones. This is the options at weekly expected highs and lows, just so you can see them. And here's the SPX, so the real market here. I've drawn a little trend line just so you can see all the intersection. We stacked this kind of 41.35 to 41.50 zone very heavily with bear pressure. So we like the fact that the bears took control a little bit. Let's understand the 2-hour chart here. We have still 3 unfilled gaps below. We actually opened into another potential gap fill, which again strengthened the bearish market for that session. I'd like to see a bit of a rally here. I wouldn't even mind it going back to 41.20 and then to see sellers recommit to this particular chart. I would like to see sellers recommit here though. To see further buying would be kind of unnatural in the market, and it would show that, yeah, we're in a super rip, but it's not really a good thing either way. It's not good for the buyers and it's probably not good for the sellers. At this stage, markets are still bullish, so you'd have to think bull demand will be very strong. We saw that at the start of this video when we're talking about buy the dip being a very strong thing. So based on every other day this year, well, realistically the stats, you'd think it's kind of like rally into potentially drop. And that's the way the markets have been trading. Let's go over to the options. And if we refresh here for the 6th of April, you'll notice that we get a lot of options on the call side, 407s, 410s. Obviously, we're a bit underneath that at 405 at this stage, and we've got 400 puts. So it's going to be hard to get through 400 this week, and that's why it could be like a little rally into a little sell, and maybe we end the week somewhere around 400. That may make the most amount of sense. We're actually at 409 at the moment, my bad. So 405 is max pain. So that's going to be a key level. Let's look at Bitcoin. Now, Bitcoin's an interesting one because it's coming up. See these daily closes here? Nothing's closed above 28.5. So today, watch that. But Bitcoin is finding buyers. I think it's this gold play that's moved off, and it's kind of exciting the Bitcoin market. Now, if Bitcoin manages to get a daily close above there, maybe we do get our 30,200. I've talked a lot about how this scared me a little bit, and it still does. But I think reactions here, this is so critical. I'm going to be very interested. I'm going to watch Bitcoin very heavily over the next 24 hours. I'm excited for Bitcoin's opportunities moving forward. What I mean by that probably is more the bear side than the bull side, because I think we're getting close to those zones. But yeah, this is going to be critical. And you can see it chunking through these areas at the moment. So will we see sellers recommit? This could have been getting the sellers in, and now they're pushing towards that buy side. Look at them go. So certainly moving off, I would say, the gold and the weakness in the dollar at this stage. So let's jump over to the economic calendar now, and we still have a bit of information coming through. We saw JOLTS job openings on the decline there, and then we also saw ISM services PMI is now coming at 10 a.m. for New York time for the US. Then we've got unemployment claims, and then we go into the jobs numbers, 8:30 a.m. Friday. That's going to move the markets the most because the jobs numbers will really show whether the Fed's work is done or whether it's not done. And I think markets will react a lot, so will yields, and we expect to be kind of usually at key levels before that data or full neutrality. So full neutrality would be like 400 on the SPY. So certainly some key levels to be looking at this week. If you enjoyed today's content, then make sure to come and consider following us over at our other social medias. Join our cheat sheets as well. They're free, and we'll see you in the next video. Like, comment, subscribe. Thanks so much for watching. Bye for now.